Welcome to the Dividend Talk podcast, episode number 16, Quarter 3 Dividend Portfolio Review. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to our channel, please hit the like button and subscribe to us. And check out our previous episodes on YouTube and Spotify. See you on the inside. Hey, what's up, eDGI? How's things going?
Things are going well, but let's cut the small talk and let's straight go to the news. What was your news for the week?
A couple of small things. So Shell has been heavily in the news lately. They've caused a bit of a storm on Twitter, by the way. My feed has been constantly of Shell all week. I've been tagged in all sorts because I've wrote a post about them recently. But they've cut a lot of jobs recently, and we'll probably touch on that a little bit later because we have lots of questions around oil. So I won't say too much now, but pretty big in the news. There's also Unilever, which I wanted to ask you about moving their headquarters to the UK and how you felt about that. I know they tried something similar to move it to the Netherlands. It was 2 or 3 years ago, and it failed. But it's interesting now that it looks like it's going to the UK, and I was kind of wondering what your thoughts around that was.
Yeah, this is actually a really interesting one because indeed there was a lot of resistance from UK investors to move it to the Netherlands. In the Netherlands, they wanted to do kind of a, let's say, a good deal to keep Unilever in the Netherlands with, I think, some attractive dividend policies for them. It didn't work out. Now they go to the UK, and there was actually quite a lot of silence in the Dutch news. I mean, yes, it was in the Dutch news, but there was not a lot of resistance. So it's kind of like people, I don't know, gave up to it or they just accepted it. But it's really interesting how nationalism and nationalistic feelings can really play a role in these kinds of discussions, because you hear people talking about Unilever at the time also in the Netherlands that even don't have shares in it or something like that, but still matters to people. Look, from a historical perspective, if you really go back to the Second World War, when I studied that time, Unilever still exists due to the UK management at the time. And if you go through the history, I would say that although from a dividend investor point of view, you've been better off with consistent growth in dividends because it was always following the Dutch gulden and later the euro in pure dividend growth. But from a management point of view and from, let's say, stability point of view, Unilever really exists still today because of the UK influence, I would say, and the position being offshore from the European mainland. So I think, for me, it's more like a question like, will they start now growing the dividend more using the pound as a baseline? And will that mean that I will get more subject to currency fluctuations? Because that was actually a benefit so far by holding the Dutch shares for me. So I don't know yet how that will look like. That will be interesting for me. But from that, I mean, I live in Poland now. I can't be too bothered whether it's in London or in Amsterdam, the headquarters.
But I felt it was a little bit strange. The timing is a little bit strange with Brexit around the corner. Do you feel that will have a negative impact on them?
I don't know. I have no clue. I have no crystal ball. I really don't know about the Brexit itself. I don't know. For me, it's more like, what will the pound do? Yeah, and what does that mean for my dividends? What does that mean for Unilever as a stock? I mean, I have no clue.
Yeah, we all wish we had a crystal ball. So, how about you? What's your news for the week?
Yeah, so it was the same on Twitter. I gave it already a little bit ahead, but Bayer with their adjusted outlook. So Bayer is such a stock for me with what I get with what I have a hate love relationship. I mean, if I look at the numbers, if I look at their products, I love this company. If I look at their management and what they did with Monsanto, I bought the shares before Monsanto, right? And then they purchased Monsanto, and I felt like, what the fuck? I don't understand this. I just watched this Netflix episode as well about documentary about Monsanto and how they were, how you say it, how they were terrorizing farmers to buy their products and really also make the life of small farmers really difficult by lawsuits and such. And then I hear Bayer, a German decent company, yeah, that buys such crooks like Monsanto. So it didn't make sense for me at the time. And now if I see how it's playing out, there's only one winner, and those are the former shareholders of Monsanto. They're laughing the hell out of this. And so for me it's like it's the poison cup needs to be drunk totally. I don't know how far they are yet. They still have only 80% of the plaintiff lawsuits covered with the 10 billion settlement. So that's still out there, 20%, and we don't know how much that will cost. At the same time, now with the agriculture business doing not so well as expected, they are doing impairments. I'm wondering how much they will start impairing on the goodwill, which means that the company will get less equity if they start doing impairments, which means that the debt ratio becomes higher. It means that they maybe their credit ratings drop. This is all a little bit ahead of them, but at the same time, if you then look at the announcement, they say that sales will be relatively flat and core earnings will be slightly lower, which means they have still really strong earnings. The only thing that really caught my attention where I'm actually the most worried is that they said that their dividend policy will be around 30 to 40% payout and then on the lower range. So what are they telling me here? Are they telling me here that their dividend will be cut by 20 or 30% next year? So that's what I find a little bit fake. And again, I'm really picky on that because I always imagine I'm today, if I would be today living off those dividends, and management of the companies from that I own stock in would all decide to cut 20% of their dividend distribution, it means like loss of income. So I don't take this lightly. Yeah, there's such announcement. So I'm a bit worried that it might lead to a dividend cut.
Yes, certainly keep an eye on that. I'm not too sure. I haven't looked into them as much as you have, but certainly the news lately has not been positive. So I'd probably be staying away until
Well,
things pick up.
don't be surprised that after analyzing it, and it's now around 45 euros, that I will pick it up at 40 euro because this stock supposed in the normal circumstances, it's supposed to trade around 100 euros, not around 45 euros. If they wouldn't have this lawsuit with Monsanto, it should have been around 100 at least.
Yeah. Okay, moving on to some lighter news. Or it's not even news, but it's about Bears Wolf S&P 500 Major League on Twitter. I know you're involved and I'm involved, and he has this whole concept of pitting companies against each other in a kind of a Champions League format, so to speak, and it's quite interesting. I know in the first round I picked Nvidia. I think that's what they're called. But I mean, it's an interesting concept. I know you're playing too. It's almost like gambling, isn't it, in the dividend investing world?
Yeah, I love it. I find this idea really great. And every day I will vote on his tweets. And, he's going to spend 1,000 euro on it.
Yeah,
Yeah. And what he's getting now is kind of crowdsourcing to get, to understand what we think collectively is the best investment out of all of them. I find it a brilliant idea. I love the gamification in it. So I'm a happy player there. And I would advise every listener to follow Burswolf and just join us in everyday voting for who you think will go to the next round, and let's see who wins. I'm quite curious there. I like it.
yeah, great stuff. I'm looking forward to seeing who comes out on top at the end.
Yeah, exactly.
So moving on to our main topic this week. So we're going to have a look at our Q3 portfolios and just chat about the performance a little bit. So I'll let you do the honors and lead if you don't mind.
Yeah, cool. So I will do a little bit like what we did with the Q2 portfolio review. I have a similar graph again. People that are listening on YouTube, they can see it on the screen now. For others, I will try to go through it. So in Q2, I made a lot of acquisitions at the time because this was April, May, June. It was really after after the Corona crash. Let's call it like that. I slowed down during Q3, so I only made 5 purchases. The first one was AT&T, so I had owned already like 50 of those based on Q2 acquisition, and I now purchased another 50, so I've got 100 shares, and this is the max of what I want to own for AT&T. It's a 4-tier position, and I keep it like that. But also I purchased 3 times additional Danone. So my Danone position, which is a tier 1, is now approximately 50% of where I would like to have it. I can expect that around these prices, I would do still another contribution to Danone in Q4. And then I probably will pause it a little bit to let the company prove my thesis. And then later I can still buy in 2 or 3 years from now again, when there are another opportunities. But now I would like to start seeing it play out a little bit, start to recover also a little bit in share price, to see the dividend growing in Q1 next year as part of the dividend announcements. So that's how I will treat the owners. So I purchased three sets of stocks again. I think I'm now around 150 shares, something like that. And those were my main acquisitions. And then just for the sake of like being pure in all the acquisitions, I also purchased 5 shares in Royal Dutch Shell as part of the dividend reinvestment. So with Royal Dutch Shell, I've got the reinvestment button ticked in, turned on, and so every quarter, it automatically reinvests the dividends. I also sold a little bit. I sold the after merger of UTX and Raytheon. It did several spin-offs, so I felt like I need to clean up my portfolio a little bit. UTX, I just bought one time on a Blue Monday, out of nothing when I saw it, so I sold it again. So those were my acquisition and sales. If you then look at my net dividend income, for July, it grew really, really a lot. But this is really simple. There were few European companies, and specifically, I think Danone, that postponed their dividend payment from, I think, March or April to July to sit out a little bit on how COVID would develop. There was also a strong push from the French government to not pay at that time. So hence why it shows it 243% increase, but that's really a bit artificial. From August, my net dividend income grew by 21%, 22% compared to last year, and September 4.6% compared to last year. But on average, my net dividend income grew by 29% over the quarter compared to last year. And I think on a quarterly basis, it gives a much more reflective way. And also, I can say already that after the first 3 quarters of this year, I already equaled the same amount of dividend that I got paid last year. So the upcoming quarter for me will be all additional there. And what is really nice now, I'm now investing for 6 years. And now I really start feeling the compounding because I have around 2.5 months of worth of dividends. So if you look at my monthly contribution, what I put in there, I get like 2 to 2.5 months of additional contribution just from dividends. So I'm actually investing 14.5 months per year now, which is really significant. And that also shows me if for the YouTube watchers, you can see that my dividend income is around 24% projected annual dividend income. So it's really nice now to see this compounding effect, and really the snowball is really rolling, which is a really great feeling. Okay, really quickly, then also my portfolio statistics. So my portfolio yield went up to 4% from, I think, 3.6% last time. This is mainly to do with the fact that my portfolio stayed flat. Oil dragged my portfolio down, and the acquisitions just contributed to fill the gap. But with that, I got new dividend incoming, hence why the yield of the portfolio grew. At the same time, I think at Microsoft growing a little bit, but the majority was from the new acquisitions. My largest sector was consumer staples in Q2 with, I think around that time, 25-26%. It grew to almost 30% now, and that's mainly due to the Danone acquisitions. My largest holding is still Microsoft. It was almost 10% in Q2. It went to 9% in Q3, mainly due to the new acquisitions. But my largest gross dividend paying company stayed Omega Healthcare Investors. And close second is ExxonMobil. And, most of us as the investors that I also see in Twitter are a little bit concerned about that. I have the same concerns. It's over 10% yield at the moment. And usually that's a red flag for an upcoming dividend cut. So yeah, this is my review for Q3. I'm not too happy, of course, with the drag in oil, but let's knock. At this moment in time, the dividend is still coming in. So as long as my cash flow is still there, then I'm happy with it. But I wouldn't be surprised with a dividend cut from ExxonMobil, honestly. And I will lick my wounds at that moment in time.
Would you not consider selling beforehand, preempting, like kind of knowing that it's kind of imminent? The signs are there. Is it something that you take action now on, or are you just going to wait and play it out?
So I've been thinking about it actually quite a bit this week. But in that case, first I'm thinking like, well, does that then mean that I don't believe in oil anymore? No, I do believe in oil. And if I wouldn't believe in oil, what has changed? Because in March or April, I was totally different, right? Yes, the price started crashing, but my question is, why didn't I sell then? And the only logical reason I have in my head is that the oil price, that I would have changed my thinking about oil, and I haven't changed so much my thinking about oil. That's kind of the thing. So, and then the question is, when do I usually sell? Is after a dividend cut or when fundamentals change? So have fundamentals changed? On the short term, yes, definitely due to COVID-19. We just see that there is less, there are just simply hardly airplanes in the air. But on the long term, no. So the question is really for me like, how long can ExxonMobil ride out those short time fundamentals? I honestly think if I wouldn't have had oil in the portfolio today, I would have probably started building up a position, because I believe that oil is so far down, it doesn't reflect the future consumption of oil in my mind. However, I've been saying that also with Shell at 16, with Shell at 18. Well, it's now around 10 euros. So I'm, I need to reflect better on my learnings here. So it's not an easy question to answer, but so far I'm staying on the sidelines with my decision to ExxonMobil.
Cool. Well, thanks for that. It's interesting, and the compounding effect really hits me there, saying that you're getting 2 months effectively free of your monthly repayments into investing. And look, I haven't reached that stage yet, but I'm sure anyone that has it's probably a good feeling, and it really starts to snowball and accelerate your path to financial freedom. So, no, fair play. That it seems like incredible figures, and I know talking beforehand, the dividend growth was quite impressive as well. So it seems like a solid month, even coming out of what in kind of uncertainty that's gone on this year. You seem to be growing pretty strongly.
Yeah, but most is due to net cash contributions. So, but hey, this is investment for the future, because there are a lot of suppressed stocks here, like Danone. So, yeah, if they start popping up, then it will do well for the portfolio value, but it won't do well for my, how you say it, for my opportunity to buy this company at an attractive price. So it's always like, that's the mind fucking that we have as dividend investors, right? We look at the portfolio, we want it to go up. We look at the cash flow, we want it to stay down.
Yeah.
So how was your portfolio performing over the last quarter?
So I've had a pretty busy quarter, or pretty busy quarter actually. I've sold a total of 15 companies. So I've spoke numerous times that I'm looking to reduce the number of companies I had. So I had up around 40, close enough to 40 companies. That's now down to 23. I do want to have a total of 32 in the portfolio. So there's room for 9 more, but I'm still going through that process of doing my own analysis, which takes time and stuff. So I'm not in a rush to add 9 companies. The companies that I have at the moment, I'm actively adding to them. So I've added to, I think I've opened up 2 new positions. So Unilever and Danone were 2 new positions, and I've added then to, I think it's 10 positions in total as well. So a lot of them came from the sales that I made. I just redistributed that money, and then obviously I put in my own every month as well. So in terms of dividend growth, I've actually seen a decline this quarter over last quarter, and that's down mainly due to Tanger. So we know, well, I've spoke about them before, and it's probably one of my ad hoc purchases that I kind of regret. But they had a pretty big impact. And look, my portfolio is quite small, so, and I had a large number of shares in them at the time, which made up a large percentage. But even so, the dividend was down about 10%. If I was to take Tanger out of the equation, if they didn't exist, it actually would have grown. It would have grown by about 20%. So that just kind of shows the swings one company has on my portfolio at the moment. But it was quite interesting to see just how one company and how one mistake and, making that ad hoc and going. I actually went for the dividend yield and put in more than what I should have, and it has had a negative impact this quarter. But I'm still quite happy with what I've got. I expect to see a little bit of a downturn next quarter, or at least flat, because I'm after selling a lot of good companies there. But they just don't, I just don't have a thesis on them at the moment. I may add some of them back in, but I just have to go through my own process of, I suppose, analyzing them and making sure that they fit into my tiers or levels. My projected annual dividend income is, after growing slightly, it's up around 5.3% or 5.3%, and which is quite good. I'm only a couple of years into this. I'm looking forward to getting, as I said, to your stage of 25% and being able to see that compounding effect roll in, which is, for me, is quite minimal at the moment. One thing that I have noticed is that my sector allocation is after lopsiding a little bit towards consumer staples. I think that's up around 27% at the moment. And I have nothing in materials, and my consumer discretionary is actually down to 2%. And that was up around 20% before this quarter. So I sold a lot of consumer discretionary companies. I don't know if that was by design. It certainly wasn't. I actually sold companies that I thought were overvalued at the time, and I didn't have a thesis on them, or I didn't have enough research. So it's interesting to actually plug back and see how my sector allocation has changed. AT&T are still my biggest holding, but Realty Income is closing that gap, followed closely by Danone and AbbVie. In terms of dividend, I think T are still my biggest position in that as well. So I think they are paying like nearly 15% of my overall dividend income. So that's going to change over, because I'm not buying any more shares in T. I have, similar to you, I have 100 or so shares, and that's enough for me. Again, they're also in the lower levels for me. So I'm looking to build, say, my top tier positions now. So that's kind of my focus for the next quarter. Interestingly, actually, in the last episode, I spoke about portfolio attribution, and I compared how my allocation was down against a set of ETFs and how they're actually comparing. And it was a disaster last quarter. If you remember, I was down like nearly 6 or 7%. The return at the moment from the year is, I'm actually up nearly 2%. I'm still underperforming the ETF allocation, but it's a lot closer now. It's nearly 1% in the difference. So I'm starting to close that gap, and that's probably down to choosing core companies now. And I'm not seeing too many investment opportunities. I'm trying to get involved. Like the ones that I'm seeing that are undervalued are the likes of Shell that I know is quite ambiguous at the moment. But I see opportunity there. Walgreens as well. Their share price just keeps falling off a cliff.
Yeah.
But I don't want to overexpose myself to those areas. So I find myself buying some shares in Microsoft who I think are a little bit overvalued, but I have a better outlook on them in the future. So it's a bit of a
Yeah.
balancing act at the moment. But I'm quite happy with how it's progressing, just to see month on month how it's growing. I mean, I'm averaging 3 figures every month, which if you had said that to me 2 years ago, it was like a big achievement. So I'm now pushing to get that to 4 figures.
Really nice. So you've had kind of a summer sale and a summer cleanup. It's like almost cleaning up your closet after several years and throw away some old clothes and purchase some good quality clothes in return.
Yeah, look, it was well overdue. I've spoke about it long enough, and I was quite surprised I actually sold 15. I didn't actually believe it was that many, but yeah, looking at some of the companies, and I don't even know why they were in my portfolio. So I'm kind of glad I'm going through this exercise. I may add some of them back. For example, I did sell Pepsi, but I thought Pepsi got to a point where the value didn't quite match. I might re-add them, but I just need to do a little bit of a deep dive on them.
Yeah.
And
Cool.
I did also sell ExxonMobil as well, by the way.
Oh, when did you sell them then?
I sold them, I can tell you, 2 months ago. I sold them.
So you have some good opportunity costs saved there because then probably you have like $10 per share kept in the pocket compared to the price today.
Yeah, yeah. And to be honest, I'm not too bullish on them for the future. I am concerned about the dividend cut. I do
Yeah.
believe it's coming. The signs are there. They don't want to cut it. That's obvious. They're trying their best not
Yeah.
to. But if levels stay the way they are, I can't see any way out of it for them. So I hope they don't for you, obviously. And I may revisit them in the future. But right now, I just saw
Yeah.
better opportunities with elsewhere, and I'm happy with Shell. I believe in Shell future. I do believe that they're, I don't know, going to be in for a tough time and the share price will drop a little bit more. But I'm more bullish on their outlook in the future because they're still going to have the oil than I am with XOM.
Mhm.
So that was
Yeah.
my reason for selling.
Yeah. ExxonMobil, I just give my opinion about it, but I think we totally think alike about this one.
Mm.
I just have it in my portfolio still. So cool. Well, I think it sounds like you're really nice on track, EMF. If I hear that, I think you're really well set up also for the upcoming year, effectively, because some turbulence is coming with the presidential elections and a second wave. You know, so
Yeah.
I think you're pretty well set up.
Yeah, I'm getting to a balance of where I like, and really nailing down my core portfolio is going to be key, especially going into next year. So that's my main focus for the rest of the year.
Yeah. Cool. So let's close this part of the topic then for the show, the main topic, and let's go to some questions from the listeners again. And I think there's quite some oil in here, oil related stuff in here today. So it seems to be on many people's mind. But let's start with Andrew first. So he says, I've been assessing Glaxo Smith and have opened a small position. What do you think of this as a good pharma purchase? GSK. Any thoughts there?
Yeah, I like GSK. That they're a company that I've always looked on from afar. It's just that they have a factory actually quite close to where I live, so I do like companies that are close by, and I pay a little bit of extra attention to them. The dividend yield is quite tasty at the moment. It's 5.2 or 5.1, 5.2% at the moment, and the payout ratio, both earnings was below 60% and free cash flow was below 50%. So it's quite strong. They're not a huge dividend growth company. So that's one little bit of my concern. The dividend was unchanged, I think, since 2016. And they've had a little bit, like everyone, they had a little bit of a turbulence this year. The pharma section was down, and the vaccine section was down massively because people obviously couldn't go to the doctors and get their vaccines. So it took a huge hit. but they did have some positive news. They have this merger with Pfizer in the consumer healthcare division, and that was up 25%, which is incredible when you think of the year we've just have. I believe that they're planning for this merger to be its own entity within 3 or 4 years, which will be interesting to see how that plays out. But for me, the most worrying thing is the amount of debt that they carry. And in terms of a dividend growth investor, how that's going to affect the actual dividend. So they did take over, I think it's called Tesaro, in a 5.1 billion purchase. I'm unsure how that's going to play out. I mean, I think a lot of this really like my main focus on this is how I feel this merger is going to happen with Pfizer. I think that's going to be key. And this debt is hugely, considering they don't grow their dividends so often, this debt will be key for me. So I think they're a good company overall, but from a dividend growth investing standpoint, it's not a company I would invest in, but they still are a nice company.
Yeah. Cool. Thank you. I have similar thoughts around that. I would just also like to advise to Andrew. Andrew, look a little bit deeper into their pipeline, please, because I'm not so convinced about their drug development pipeline. I didn't find them so successful over the years, and that's maybe also one of the reasons why the debt pile is so high and the dividend has been relatively flat or just flat. So, Andrew, have a look at the pharma pipeline and try to see if you see any hope there in real growth, yeah, or not just pipeline replacement, but you want to see growth there as well. So, and that's usually a typical thing with the pharma companies. And how it works in a pharma company, you cannot bet on one horse. So you also need to look at how much research they are doing, and really check about how many are in phase 1, phase 2, phase 3. What is the rate of success? You can get these statistics from any pharma company, typically from the annual report, because that's what investors look at. And then you need to understand also, like, what's the potential cash flow, and just Googling already for this and looking up an analyst report might give you this confidence or not. If you don't have the confidence and to the point of there, then don't expect dividend growth here.
Good advice. So we move on to our next question from Danny, and he asked our thoughts on how Trump catching COVID might affect the presidential race along with the stock market.
I love this question. I mean, we had the UK Prime Minister as well with COVID, right? I mean, this is actually just a question. First of all, I think Trump is quite a controversial president, so to say. There are people that hate him. There are people that love him. Let's say like that. I think, first of all, anyone getting COVID, I mean, I really hope that they get healthy and stay healthy no matter who it is. And I hope the same for Trump and his wife, that they will do well. And how it will affect the presidential race, again, I don't know. What I can envision is that, for instance, the debates will look differently. But look, I saw some news flashes of the first debate, and I think it's probably even better if there wouldn't even be a debate anymore, because it's just shameful what's happening there. They totally have no respect for the audience, the listener, and for each other. So it's like two kids fighting over a lollipop and whom got which color. I mean, I learned as a father to always buy the same color of lollipops, because if you have two different colors, you have like a debate like Trump and Biden have. And this is what I was seeing. Yeah. And I mean, so what will do to the stock market? So my thoughts, I shared that on my blog before. I think there's a Trump premium in the market. I think if Biden becomes president, I think we might see at least a short decline, because he's going to increase the taxes. At least that's what he's saying. And this is just all not really good for corporate America, which means probably less money for growth, earnings pressure. That's why I think about the Trump premium. So the question here really is, do I think that Trump will win? I think people are over optimistic about Biden winning. If I just think about the normal person in the street, also in Europe, please don't be surprised how many people are fan of Trump in Europe as well. If you just go walk into the street where you see more poverty, there are really, really many supporters for right-wing candidates and also candidates like Trump. Yeah, so, and people should not underestimate, because if you work in a corporate or something like that, or you come with an educational background in university, we often live in a bubble. But just walk in the street somewhere and talk to them, and you see that they have a lot of supporters. And yeah, I give the 50-50 chance that Trump stays.
The timing of the announcement of COVID was a little bit I don't know, suspicious maybe. I'm not sure.
Yeah.
Look, I hope he's healthy, and I hope his wife's healthy, obviously, but I just believed the first debate was such a disaster. Like you, this is, to me, it's like a game plan. They have a plan, and it's going to benefit him in some way or form. I don't know. Maybe I'm being too skeptical here,
But you
but
think planned? I mean, you think literally that he would have injected COVID into him to
no,
just be
no,
able to claim this? No?
no. I just don't think he has it. Just plain and simple.
I was thinking today, I actually told someone, I said, like, imagine that this COVID for him will be just a cough. Yeah,
Yeah.
like that he just gets away with a cough. Imagine how he will use this to downplay the whole virus. Like, oh,
Oh,
it's just a cough, it's just something for weak people. Yeah.
yeah. It's look. It's going to form part of his game plan. I'm sure. Politics is
Yeah.
politics. If he does have it, as I said, I do hope he stays healthy and gets healthy. But I mean, he's going to get the best possible healthcare in the world.
Yeah.
He'll be well
Yeah.
looked after. So I'm sure he'll be fine. In terms of the stock market, I'm expecting lots of volatility. You can see with the COVID announcement, there was drops in oil, there was drops in all
Yeah.
sorts. So we can expect a lot of this over the coming months, which look will present some buying opportunities. We hope so. It's worth keeping an eye on, and I'm not sitting through another debate again.
Well, let's go to the next question. Centrino, he's asking about ExxonMobil. Buy now for its high dividend yield. Oil is there. His assumption is that oil is still there for many years, or run away because future is electric and gas. We just spoke about it, right? So I'm rather thinking sometimes, like, should I mean, I don't see myself selling the whole position, but just selling parts of the position from the other side. Yeah. So again, if you be a total new investor, I would rather go for a company like Shell at the moment, not ExxonMobil, because I think with Shell you have a more future-proof play. They are at least aware of the fact that energy is transitioning. I don't have that feeling with ExxonMobil. There are no plans there. And if you do it, I would just buy something and maybe even buy a put option below it to protect your capital for over the half year and see how it plays out, because I think it will be really volatile until the winter finishes, I think, because then COVID-19 might start to disappear, the vaccines are there, and you might benefit then from kind of a bottom around now. Yeah. So, but then buy a put option, just invest these 1 or 2% on top of it to protect your portfolio a little bit. That's what I would recommend today.
Yeah, I mean, I agree. Oil is not going anywhere. We know there is a future in oil. There'll be some sort of future. I would probably be a little bit more comfortable investing in ExxonMobil if they actually cut the dividend and I knew where they're going to stand financially. I mean, that's a little bit counterintuitive to what we say all the time. But I mean, it's for me that dividend is a little bit too uncertain and unstable currently. If they get through this, and anyone that has stuck with them will obviously reap the rewards. And if they're buying now, I mean, fair play. But like you, as I said, I don't see the rush. We still have the winter to get through. There's no planes up in the sky. So I don't see an immediate rush to buy them. I still believe the price will be depressed when we get to Christmas, for example. So there's still time. You talk about opportunity cost earlier. If you're to invest in them now with the same thesis that I have, I'm losing money because there's better opportunities out there.
Yeah.
So I 100% agree. There is a future there, but like you, I'm more comfortable investing in Shell, who are radically trying to change the culture and trying to change directions, as well as keeping a foothold in oil. So, I mean, I'm not buying right now. I may change once we start seeing light at the end of this tunnel, or if they cut their dividend, and I can get a kind of better feel of where they are financially.
Cool. So let's go then to LETUSCOMPOUND, because it's a nice bridge to the next question. Thoughts on your favorite laggard Shell? 30 minutes rant, please.
Yeah,
Okay.
I'm going to go for a cup of tea and just let you talk for 30 minutes. Yeah.
Yeah. So Shell is really a great company. Like how it's run, it's with Ben van der Burde. In my opinion, it's a great company. He was one of the first CEOs in the whole oil industry to recognize the fact that energy is transforming, changing. That's why they bought British Gas in 2016 when the oil price was bottoming, because they see gas as a transition how you say it, energy source. They're able to liquefy it. They're heavily invested in that. The thing is that gas prices are also suppressed together with the oil prices because it kind of correlated there. Although, yeah, it doesn't always make sense, let's say. But again, that's how the price action works. Now again, they're downsizing. Their business model is changing. They are using these opportunities. I mean, why do they still need so many people if they're not building so many new assets anymore in their upstream business? Yeah, because that's where most of the cuts will be happening. We're talking about 10% of the workforce. If you think about that, it's not that huge, right? It's not like we're talking about 40, 50% here. It's 10%, which is a huge absolute number. But if they are downsizing 10 to 20% in their portfolio in the upstream business and capital investments, then hey, that comes also with people, right? The people won't be doing nothing. So I just think it's really good companies trying to transform into the future. I'm still not certain about whether they will find the same margins in their new ventures as the margins that they would have had from oil, like in the old days. I think there are just different dynamics, and we spoke about that a little bit earlier in one of the shows as well. I think wind is for free, solar is for free. So they would probably become more like a utility company. Not sure about the margins there. That will have to play out. But yeah, at the same time, it's almost ticking 10 euros now. It becomes almost a single digit number. And for me, if I would be a new investor, and again, I would have no energy yet at all in my portfolio, I would really start buying something there after a dividend cut of 66% or something like that. I think they have done all the stuff that you would have expected from someone who's also a little bit prudent in their in their in their investments. So I think there's just a lot of prospect for Shell, but this is really, what we are doing, what we're talking now about is the same as at the bottom of the crisis in 2009 after the banking. People were thinking that the world was collapsing at that time. It's the same with the oil industry now. So it's no wonder that everyone is really depressed about energy and the future forward look. And then they see Tesla share price fivefold from what it was not too long ago. So like the whole world would go into electric. So I understand all of this. So the question is, do you have the nerves at the moment to invest in such a company? I think if you buy some now and put it on the shelf for the next 5 years, honestly, I think you will do pretty well. And if you doubt again here as well, buy a put option for protection for the upcoming half year. If and just invest that, because let's say if I don't know what a put option costs, but let's assume it costs like 50 cents or something like that, and you would buy now for 10 euro, so it would cost price would be 10.50. If this share price goes to 15 within 5 years, then this 50 cents as a insurance for your nerves is not that bad. Yeah, let's not be penny wise, pound foolish here.
Yeah, I mean, I completely agree. I've been quite vocal in my support of Shell and what they're doing. I was expecting the job cuts. I mean, if you read the last reports that they've done, and look, they're trying to streamline the business, and it's part and parcel of that, isn't it? And it makes business sense. It's not nice for the people involved, and yes, it hit the news, but it was kind of expected. I'm. It was funny how you mentioned Tesla there a minute ago, and remember the tech bubble bust. There wasn't so long ago when they were all at all-time lows, and people had no
Yeah.
faith in such Microsoft, for example, and companies like this. I mean, it's natural. We've got lots of questions about oil this week, and it's only natural. The prices are low, but I've said it on Twitter, and I say it again. This is the time to buy if you're bullish on the future. I mean, a lot of people have said and commented that they do see a future in oil, but in the same breath, they're thinking about selling or not buying. If you do see a future in oil, 100% now is the time to be buying. I'm lucky. I was quite young in my portfolio that I didn't have any exposure to energy until recently. So my position in Shell is quite good. So I'm not facing a huge loss at the moment, even if they went to zero. I mean, it's not a big deal, but I am still going to be adding to them. I'm adding to them probably every month. I have stop limits in place or order limits in place that when if it hits single digits, for example, I'm going to buy a good portion of them. The only thing that would really put me off them now is if they cut the dividend again, a second dividend cut, and I'm out. I'm expecting huge headwinds. I'm expecting the price to be depressed for a little bit, but I do have faith in the CEO. I think he's fantastic. As you said, he's one of the first to spot the change into renewables. I don't think we've seen the full potential of the acquisition of British Gas yet. I think that's still to come down the line. So there's a lot there for Shell. I'm extremely bullish, and I will be adding. And I mean, look, it's recorded. I've put it on Twitter. It's everywhere. I'm buying now when the prices are low, and I believe that's the best time to start buying them.
Cool. Okay, thanks, Lettuce Compound, and all the others around oil. Let's go to Phil. Is taxation a reason for you not to invest in something? The only logical answer I could say is children, because of inheritance tax.
Hmm.
It would be probably cheaper to know that to donate it to a charity than to hand it over to my kids. But no, and we had this question a lot about French companies, Swiss companies, and I look at the tax adjusted yield. So no, I not really. But I think you have another opinion on there around ETFs, if I remember correctly.
Oh man, I just dislike ETFs in Ireland. I mean, paying nearly half 50% of your profits in tax, and then having to pretend to sell them and pay tax on the capital gains in every 8 years. I mean, it is one of the reasons why I don't invest. I did buy ETFs, as I said to you before, a couple of months ago, but in that sell off, I was like, "Do you know what? I just I can't be bothered with them. So I've sold them. I just can't get over having to file out a return and every 8 years something I didn't sell and say, look, I'm going to pretend I've sold this. I'm going to calculate my gains and pay tax on this. I'm like, no, I'm not. I'm just not doing that. So tax does come into it a little bit, but like you have to pay tax anyway, don't you? So you just kind of move on and just try and find the most tax efficient or
Yes.
as best you can to do it.
Yeah.
But look,
True.
tax and debt, and is that what they say? Two things, certainties in life. So I've made my peace with paying tax. I just can't pay 50% on tax with ETFs.
Thanks, Phil. Let's go to Gary Farrell. And actually, I love this question the most because it's a company nobody ever speaks about on Twitter. So Gary asks, any thoughts on Neste OYG? So Neste is not Nestle. Neste is an energy company in Finland, and it's engaged in the refining and marketing of petroleum and products. But it's mainly well known, I think, for their, how do you call that? The diesel, how do you call it again?
Renewable diesel, isn't it?
Yeah, exactly. Any thoughts on that, EMF?
I know the Nestle comment was aimed at me because I've never heard of this company before this question. So I do really love this question because it made me go out and learn something new. And I mentioned to eDGI, I thought that you misspelled Nestle, so I had to Google it. But when I looked briefly, I spent a half an hour looking through this company, and I'm like, man, I don't know how I've never seen these, or how these are not talked about more. They have incredible earnings growth over the last 5 years. I think up around 97%. I think the figure I've seen, along with their dividend growth history of over 27% over the last 10 years, which is quite something, to be fair. The payout ratio at the moment, free cash flow, is 68%, which is average for that kind of industry. And with earnings, it's 42%. So fundamentally, at least on an initial screener basis, they looked very strong. And it's a company that I definitely will be deep diving into and getting to know a little bit more. We might even do it on the podcast if eDGI agrees to it. I mean, it was a good find. I did some quick analysis, so dividend discount model and dividend cash flow, and they were ranging from between 25 to 43. And I think at the moment they're priced at about 46. So the value might not be there at the moment. But again, from initial screening point of view, I'm definitely going to look into these a little bit further. I know you know the company a little bit better than me, so you'll probably be able to.
Yeah, I know it a little bit, and I think that you can get it in the Netherlands. You can buy their stuff in the Netherlands. I think I read the last time they have around 100 points or 100 dots where you can inside a joke. They have 100 points where you can buy their diesel, and just think about it. I think they are making the renewable diesel from waste or something like that. So think about it. That, I mean, I know there are companies out there that are trying to reproduce the I said the whole way you can produce normal diesel, yeah, based on the bacteria or the algae. They're trying to do that. This company is doing from waste, so it is a perfect play on the millennial generation. It seems to have also less pollution. So from a marketing point of view, I mean, their diesel is like a perfect spot in a blue ocean. Yes, so I think this company really has a lot of runway ahead of it. That's why it's a high growth company. And if this would have been a tech stock, it would have had a much higher multiple. So I think it is. If you're a dividend growth investor, they are, I think, paying dividends since 2013, but really rapid growth. I think it could be a really, really interesting option for a dividend growth investor for years to come.
Cool. We might do that on the show, actually, because I'm really interested in this company now. So thanks very much for that, Gerry. Appreciate you commenting and pointing me in the direction of what seemingly a good company.
Good. So these were the listeners' questions for this week. Thank you, everyone. It was, as you can hear from us, we're quite passionate in answering them. So let's go to our final phase of this episode. EMF, what's your stock pick for the week?
Yeah, I struggle this week. I'm finding it hard to find some value, and I don't want to just pick a stock out of the air. So I'm just going to give a stock that I'm buying at the moment, and that's Cisco. I've mentioned it before. I think they're undervalued, my price point at the moment, by about 20-25%. So I'm quite comfortable in investing in them. So I'm going to be buying some more shares of them this week. So not much more else to say on them, but that's what I'm buying. How about you?
So if I would say about what I would be buying, it's probably Danone. But we have said it so often here on the show that I don't want to do that anymore to our listeners. So if there's one stock that I would like to buy at the moment, and then I'm not talking about Bayer or something like that, where we are talking at the moment about a crash in stock price, I would go for Chubb. So I will be probably not buying it myself now. I would like to still see it go a little bit down, but if it would go under $110, then count me as a buyer. It's currently around 116, and Chubb is such a company for me, which I can almost buy blindly at the moment. I've done my homework on it. I love it as an insurance company, and under 110, I would nibble in a little get to extend my position. So that would be
Cool.
my stock pick from the week.
Nice. So that's it for this week. It's been interesting. I loved all the questions. Again, the questions are awesome, and I'm still chuffed at that company actually, and I can't wait. I'm probably going to spend the next couple of hours reading up on them. So thanks very much to everyone that listens and takes the time to actually write the questions. I hope we add some value, or you enjoy our insights a little bit. Thanks to eDGI again, another great episode, and interesting to hear your portfolio. And I'm a little bit behind, about 4 years behind, so I can't wait to catch up and be sitting here with 25% towards my financial independence. But no, it was a great show. Any closing thoughts from you?
Well, I think it's always easy to look at others. For instance, if I have 25%, but maybe after 4 years you had 30%. Yeah, I made many mistakes in my journey. Oil is down, so it could have been more, so to say. And I just found, when I hear you talking about your portfolio, you always make me thinking like, oh, I should do that as well, or I should do this as well. So what I just like is, and I think that's kind of the chemistry that we have, that we make each other better. So I just want to thank you for that. I don't know, we are now episode 16, 17. It's been a really quick journey. Our listeners, when we see the stats, are also really growing exponentially. So for me, it's just a great journey with you, and thanks for that.
You're welcome. So thanks a million again to all our listeners, and we'll see you next week.